This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Washington rattles Wall Street. Investors were jolted, at least briefly, as investors fretted about new emails that could deepen the election meddling probe and crimp the Trump agenda.
Amazon effect as people shop for deals increasingly. Do brand names matter less than they used to?
Best for business. Does your state rank near the top? And if it does, it could mean more jobs, higher wages, and a better quality of life. Those stories and more tonight on Nightly Business Report for Tuesday, July 11th.
Good evening, everyone, and welcome. Now, the conventional wisdom is that stocks have risen this year in part because of the new administration's decidedly business-friendly agenda. But is that working plan still intact? That was the running question today for investors who are focused on the potential for tax cuts, health care reform, infrastructure stimulus, among other things. Now, this morning, the Dow Jones Industrial Average lost more than 100 points in a very short amount of time, as you see right there, after Donald Trump Jr. released emails about setting up a meeting with a Russian lawyer dangling potentially damaging information about Hillary Clinton last year. The swoon was sharp but quick. Stocks recovered and later recovered even more after the Senate Majority Leader said he expects a vote on health care next week and is pushing back the start of the August recess, signaling to Wall Street that the agenda is still very much alive.
We've got the defense authorization, we've got the debt ceiling, we've got the FDA user fee and other important legislation that we need to address, and we simply, as a result of all this obstructionism, don't have enough time to address all of these issues.
By the end of the day, it was pretty much a wash on Wall Street. The Dow Jones Industrial Average rising a fraction to 21,409. NASDAQ added 16, and the S&P 500 was off nearly 2.
Washington will be the focus for investors tomorrow. That's when the Fed chair delivers her mid-year economic outlook, and she gives it to Congress. Janet Yellen's testimony comes amid a strengthening job market and low inflation. Investors will be looking for signals on future interest rate hikes, as well as when the central bank plans to shrink its massive bond portfolio, which had accumulated during the financial crisis. And today, Fed Governor Lael Brainerd said that she would like to press ahead with plans to shrink the Fed's balance sheet, but sounded a note of caution when it comes to further interest rate increases. Federal Reserve policymakers meet later this month.
Michael Farr joins us now to talk more about Washington's impact on Wall Street. He is the president of Farr Miller in Washington, and he joins us now from the nation's capital. Michael, good as always to see you. A lot of attention today on these emails, but I sense that the more important Washington story to watch for investors will be tomorrow, Chairman Yellen's testimony on Capitol Hill and a couple of the Fed speakers today.
Tyler, I think you're right. I think in spite of all of the market noise that we've seen recently, and there has been a lot of it, we have still seen markets driven largely by monetary policy and comments from central bankers, not only in the U.S., but central bankers around the world. So while we had news from Donald Trump Jr. today, and while we had news from Capitol Hill about trying to get some agenda done, I think it all will still come down to the Fed. So what Chairman Yellen says tomorrow and the next day, pretty vital, I think, to the future markets for the rest of the year.
How does the market look to you overall at this juncture, Michael, given the fact that we had the volatility midday that we saw today? Overall, how does the market feel?
Well, it continues to feel high, Sue, and talking to investors around the country over the past couple of weeks, almost every conversation has been, Michael, why is the market still up? It hasn't gone down. I had a man last night say, I've been buying options to protect my portfolio. I've been wasting a lot of money. When do I stop? When will it go down? These, though, Sue, are conversations that you don't hear at a market top. At a market top, people tell you you can just buy everything you ever wanted to buy and it's never going to go down. So with this level of fear, even though prices feel pretty full, it looks like it could continue on for a while longer.
You know, we had on the chief economist of the Investment Company Institute last evening, Michael, and he pointed out that money is flowing into bond funds in a big way. He gave some very understandable reasons for that, but interest rates are rising. What do you think the outlook is for bonds for the rest of the year?
Well, you know, I think a couple of things are happening. Certainly, foreign investors are buying U.S. bonds, particularly as rates rise. And as those rates rise and they need dollars to buy those bonds, that drives the dollar higher, too, which creates some GDP problems. I think there's also something going on that, you know, in many ways, people really, a lot of investors don't believe the real growth story, the real robust economic growth story. We're not seeing wage gains. We're not seeing a lot of the things we normally would. It's a wait and really show me kind of a bond market, but there's certainly sources of cash. I think you also have to pay attention to what Fed Governor Powell said at the end of last week, which was they're focusing on Fannie and Freddie. This is one of the most respected Fed governors out there. When they focus on Fannie and Freddie, that drives long rates up. So the Fed is focused on getting the whole curve up. Be careful and listen to Chairman Yellen tomorrow.
The Far View from Michael Farr with Farr, Miller, and Washington.
Thank you.
The Federal Reserve doesn't just set monetary policy, it also regulates the nation's biggest banks. And President Trump named a former Treasury official who has been critical of the Fed in the past as his pick to be the central bank's top Wall Street watchdog. His name is Randall Quarles, and Hampton Pearson tells us who he is.
The Trump administration's first nominee for the Federal Reserve Board of Governors is a financial industry veteran with experience in both Bush administrations. Randall Quarles is due to become the first official bank and regulatory supervisor at the Fed, with also a vote on monetary policy. Quarles, who currently runs a private equity firm in Salt Lake City, was a partner at the Carlyle Group. He served in the first Bush administration, focusing on capital markets, and he was undersecretary for domestic finance while George W. Bush was president. Leading financial analysts view the nomination as favorable for bank stocks. A note from a leading firm says Quarles would be expected to take the lead in rolling back banking regulation. We think the nomination is generally positive for bank stocks and in line with the Trump administration's agenda to review the Dodd-Frank regulatory framework. On monetary policy, we expect Quarles will lean slightly to the hawkish side, but not significantly so. We do not think his appointment to the Fed will change the ideological balance of the FOMC. Since Quarles' name first surfaced back in April as a leading candidate for the Fed, reaction from the banking industry has been generally positive. He will face Senate confirmation. For Nightly Business Report, I'm Hampton Pearson in Washington.
One of the Fed's mandates is full employment, and today we learned that there are more than 5.5 million job openings in the U.S., though that's down from the prior month. It's close still to a record. According to the Labor Department, the number of people who quit their jobs also rose. That's a positive sign for the economy, a signal that workers feel confident they can find a new position. But the glut of advertised jobs is being blamed in part on a shortage of skilled workers.
And that shortage of skilled workers is being felt across the country by companies both big and small. And right now, it appears as if small business owners are also concerned about what's happening in Washington, or more precisely, what is not happening. Kate Rogers takes a look.
Main Street's mood has taken a turn for the worse as political uncertainty in Washington continues. The National Federation of Independent Businesses' monthly read on sentiment fell in June to its lowest level since November, reversing a trend of rising economic optimism. Fewer business owners expect the economy and sales to improve, and they're blaming it on gridlock in Washington. The conservative lobbying group using pointed language in its report, saying that while progress is being made, it's being poorly communicated, and that Main Street's two biggest issues of tax and health care reform are, quote, stuck in the bowels of Washington politics.
Washington in general has a bad reputation with small business owners. And the fact that the Senate right now is deeply mired in some endless discussions about the fate of Obamacare repeal does not help. I think if we go into the August recess without some kind of significant advance on Obamacare repeal and small business owners seeing some kind of progress on tax reform, you'll see some very interesting numbers in August.
Some Main Street advocates are holding out hope that small companies are still optimistic enough to hire and expand.
I think small businesses are still in a reasonably good place compared to where they had been. There's optimism and there's growth. The economy is doing okay. And one of the real indicators is that they tell us they're having trouble hiring people, which tells us that they're trying to hire people and that the economy is pretty good.
Another issue small business owners are grappling with, finding the right workers with the necessary skills to hire. And that's a problem big business owners are dealing with as well. For Nightly Business Report, I'm Kate Rogers.
Still ahead, should you be able to join a class action lawsuit against your credit card company or bank? It is the latest debate in Washington and on Main Street, and it's a big one. Pepsi decided to raise prices, focus on new products, and cut expenses to fuel growth, and it worked in the most recent quarter. The snack and beverage company reported a rise in both earnings and sales and increased its annual earnings forecast. But while pricing was up, the amount of products it sold overall was flat, and that's okay, according to the company's chief financial officer.
About 8.5% of our revenues are coming from products over the last couple, introduced within the last 3 years. And those products typically are not big on the volume side. They typically are more premium oriented. And as a result, we're getting higher dollars per ounce or higher dollars per pound. And that's why you see a bit of the muted volume growth relative to the revenue growth.
Investor reaction tepid today, and there are concerns on Wall Street that Pepsi's price increases could backfire as consumer tastes change.
And for companies like Pepsi, much of its power is in its brand. But that could be changing in part because of Amazon. MarketWatch cites one industry analyst who says consumers are being influenced by the e-commerce company shopping based on price rather than on brand name. And the Wall Street Journal points to a startup that sells generic products for just about everything for $3, cutting out traditional supermarkets and marketing. So are big brands and the prices that they command being tested? Here to talk about that is Tom Blystock. He's chairman and CEO of retail consulting firm Dialogic Group. Welcome, Tom. It's nice to have you here.
Great to be here. And Tyler, nice to talk to you also.
You know, it does seem as though these brands are certainly being tested. What should their response be to an Amazon that is now expanding into almost everything?
Well, Amazon is without question going to be a giant. And if we fast forward to 2025, about $100 billion of traditional grocery store sales will move online. So brands will be tested, but brands are going to be tested in ways that are different. They're going to have to balance their thinking as to how they serve the traditional grocery store market, as well as how they serve Amazon as partners. So what we're going to see is many of the brands are going to focus on premium and super premium as ways to differentiate, as well as balance their portfolio of what goes online, what goes offline.
You say that they have to decide how to play retail and retailers like Amazon. What does that mean? I think you just hinted at it in part. In other words, that they have to go super premium, which means up the price scale?
Well, how about up the value scale? So 72% of Americans are struggling to live on a day-to-day basis. So when I talk about super premium, we're going to have a series of premium brands, regular brands, as well as super premium brands. What will be interesting is that as the manufacturers go to market, they'll decide which pack sizes, which products go into various channels. So the idea is to balance their thinking, balance their strategies around, do I invest in a traditional grocer? By the way, traditional grocers are not going away. Do I invest in online, pure play, or hybrid retailing, which is a combination of both online and offline?
Are many of these companies capable of doing that? I mean, that's a huge challenge. Maybe the big guys, like we mentioned, you know, Pepsi and things like that. But what about the medium tier companies who have a decent footprint, but that seems to me to be quite a challenge for some of them?
Capabilities-driven strategies, the ability to understand where to invest and where not to invest is going to be a big challenge. Skill sets are going to be a big challenge. Deciding exactly how to balance the innovation portfolio, deciding on which channels to invest in. Do all of them have the capabilities? No. I'd probably say that the top 10% have the capabilities. The rest have to grow the capabilities.
On that note, Tom, thank you very much. We appreciate it.
Thank you. See you guys.
Tom Blystock with Dialogic Group. Amicus Therapeutics gets the all clear to file a new drug application for a deadly disease, and that is where we begin tonight's market focus. Last year, the Food and Drug Administration told Amicus the biotech had to provide more data on its medication for treating the rare inherited disorder called Fabry disease before the agency could consider approving it. But now the FDA says it will evaluate the drug's existing data. Amicus said it's on track to file for approval by the end of this year. The shares rose 26% on the news to $12.92. Another drug maker, Arena Pharmaceuticals, said last night that its experimental drug for a rare but deadly lung disease did well during a study. Arena said the encouraging results give it confidence to move ahead with the next stage of testing. Today's shares spiked 41% to $26 even. Rent-A-Center has rejected an $800 million buyout offer from the private equity firm Vintage Capital. The furniture and electronics leasing company disclosed in a filing that it received the unsolicited bid last month and determined it significantly undervalued the company. Rent-A-Center shares were up 9% to $12.09.
Consol Energy moving ahead with its plans to spin off its coal business. In a securities filing, the company said its board has approved the move that would result in two publicly traded companies, one focused on coal, the other on natural gas exploration and production. Consol Energy shares were up nearly 6% to $15.81. Microsoft wants to make sure rural communities in the U.S. have access to high-speed internet over the next 5 years. Microsoft plans to fund and launch broadband service in 12 states that will connect 2 million Americans to faster internet. Shares were up a penny to $69.99.
The Consumer Financial Protection Bureau finds itself in the middle of a controversy. Today, Republican Senator Tom Cotton said that the CFPB had gone rogue, and he plans to eliminate the agency's new rule that could help consumers sue financial firms. As we reported yesterday, the CFPB wants to get rid of mandatory arbitration clauses that ban class action lawsuits.
We have both sides of this argument tonight. Richard Hunt is president of the Consumer Bankers Association. He supports keeping an arbitration clause, while Rohit Chopra believes that banning that clause will hold banks and other financial institutions accountable. He's senior fellow at the Consumer Federation of America. This one is just sort of going to be a easy one for me to get going, I think. Mr. Hunt, you believe that arbitration is actually better for consumers, though it's worse for class action lawyers, that the consumer comes out with more money typically than in arbitration than in a lawsuit. Explain.
Well, it's not my saying this. It's the CFPB who said that on page 198 of their own study. Their own study concluded that if you're in arbitration, you receive an average of $5,400, yet if you're in a class action lawsuit, it's $32. So maybe only in Washington, D.C. is $32 greater than $5,400. Let me tell you the big winner yesterday from the CFPB, trial lawyers. Trial lawyers take about 1/2 up to $1 million per lawsuit out of hands of consumers. If the CFPB really cared about consumers, they would have capped how much trial lawyers may be able to receive. So arbitration has been around since 1925. Our banks have been around over 200 years. We have a great relationship with our consumers. It is less costly and much more quickly to go through arbitration than it is through a class action lawsuit.
Mr. Chopra, why don't you respond to that? And as I understand it, you think it's a matter of choice as well. The consumer should have choice.
That's right. If arbitration is so fine and dandy, then why do banks and financial companies need to force consumers into them? The study that Richard cites actually proves the point. People don't go and navigate arbitration red tape to claim $10 or $20. When millions of consumers are all harmed by the same illegal practice, the only way to solve it is through letting consumers group together. And you know what? Banks do this all the time. Banks join class actions. Recently, they joined class actions against Target, against Home Depot, and other companies. And banks sue consumers all the time. JP Morgan Chase, in a small period of time, sued hundreds of thousands of consumers. So if consumers can't sue banks, then why should banks be able to sue consumers? If banks can join class actions, why can't consumers?
So
and you know what this is all about?
Mr. Chopra, what about Mr. Hunt's point that when you go into a class action lawsuit, the consumer typically gets back very little because the classes tend to be very large, and the cut that the attorneys take tends to be very sizable. Quick answer, because I want to get back to Mr. Hunt.
Well, the reason why is because people file claims for people join class actions for very small dollar amounts. That study Richard cited proves the point. The average rate, average dollar amount that consumers file in arbitration is over $1,000. It's much higher. You're not going to go through the time and energy unless it's worth it to you. But when everybody is cheated by a small dollar amount, class actions really help. And the study shows that billions of dollars and legal fees do take part of the action, but overall consumers get billions as opposed to arbitration.
All right, Mr. Hunt, do you want to respond to that? And also to Mr. Choker's point that if banks can sue consumers, why can consumers not sue the banks?
Yeah, I just don't. Well, you can. First off, every bank should have the right to choose which products they want to offer. This is a Washington, D.C. bureau who is telling an American company what they can and cannot do. I just think that is just simply wrong.
But why can a consumer not sue a bank if a bank is suing a consumer?
What I don't understand, you say it's a small part. You say trial lawyers take a small part. I don't think in Washington, D.C., half of the monetary damages can go to trial lawyers. I don't think that is just a small part. And this is another reason why Congress will overturn this. I think by the August recess, I think the majority of the House and the Senate will say one person at the CFPB should not dictate all the rules, examinations, and enforcement actions. That's why we're also pushing for a bipartisan commission at the CFPB. Just too much power in the hands of one individual out of Washington, D.C.
A hot debate, gentlemen. Thank you very much for making your cases so forthrightly. We appreciate it. Richard Hunt with the Consumer Bankers Association, Rohit Chopra with Consumer Federation of America.
Thank you.
And coming up, the best state for business.
I'm Scott Cohn. Just unveiled America's top state for business for 2017. It's a story of robust growth, and we're not talking about the fish. The story coming up on Nightly Business Report.
Seattle has approved an income tax on the rich. The measure, which was unanimously approved by the City Council, applies a 2.25% tax on total income above $250,000 for individuals and $500,000 for married couples. The city estimates the tax would raise about $140 million a year. Critics, though, say the tax violates state laws, and the tax is expected to draw legal challenges.
America's top states for business now in its 11th year. CNBC, which produces this program, ranks all 50 states on things like competitiveness, the job market, and taxes. Here are the top 5. In 5th place, North Carolina, which has attracted technology and talent, but has among the weakest anti-discrimination protections. Number 4, Texas, a past winner. Its economy, once the envy of the nation, slowed down along with the oil industry. Minnesota, also a past winner. Number 3, offsetting high taxes with strong education. Number 2 is Georgia, on the strength of its infrastructure and a very strong economy right now. America's top state for business, an economic powerhouse. Scott Cohn reports from the state of Washington.
You can shop at Costco or order from Amazon using software from Microsoft, which you can also use to book a trip on Expedia on a jet built by Boeing. On the strength of these household names and more, Washington State's $470 billion economy was the fastest growing in the nation last year, a fast-growing job market and a red-hot housing market. In the annual Top State study, Washington notches top 10 finishes in 5 out of 10 categories: workforce, economy, quality of life, tech and innovation, and access to capital.
A robust, growing economy, smart workers, innovative entrepreneurs, safe communities, and a beautiful natural bounty.
But as is often the case here, clouds are building. Home construction is slowing down. Boeing, the state's largest employer, is cutting jobs, nearly 10,000 in the last year, prompting a big "I told you so" from critics of the huge incentives the state has given the company.
This experience with Washington State and Boeing is such a tragedy. Boeing is gaming the fine print of these two huge incentive packages that it has gotten from the state that total more than $11 billion.
Meantime, education here is underfunded, and the state only recently began reinvesting in its troubled infrastructure.
We know if we grow intellectual talent, that fundamentally intellectual talent is the energy source that is going to drive the economies of the future.
But the challenges leave Washington in a precarious spot and facing a nagging question. Has the state reached its peak, or is there room to grow higher? For Nightly Business Report, I'm Scott Cohn in Mount Rainier National Park, Washington.
A nice place to be. To read more about the top states for business and to see where your state ranks, head to our website, nbr.com.
And finally tonight, Warren Buffett has donated more than $3 billion in Berkshire Hathaway stock, his largest contribution yet, as part of his plan to give away his fortune. The money will go to the Bill and Melinda Gates Foundation, as well as 4 family charities. This is the billionaire's investors' 12th annual donation to those 5 charities. They usually sell the shares to finance their activities, a move that is in line with Mr. Buffett's wish that his money be spent. And that is Nightly Business Report tonight. Thanks for joining us. I'm Sue Herrera.
I'm Tyler Mathisen. Thanks from me as well. Have a great evening, everybody. We'll see you right back here tomorrow.